All right, folks. Well, welcome to today's session. I'm extremely excited to have our guest speaker join us today. Before I go ahead and introduce her, I just wanted to go through a little bit of housekeeping items. First thing is, if you have a question, if you've attended these sessions in the past, I generally answer the questions as we go through the presentation. Today, what I'll do is I'll actually hang tight and we'll ask them at the end. So at the bottom of your screen, you'll likely see there's a Q&A button or for question and answers. You guys can click that, type it in there, and we'll be making some notes along the way. I'll also have a few questions likely for Theresa at the end of the session as well. Yeah, like I said, super excited to get started here. Obviously, it's been quite a roller coaster here in the first 6 months of the year. Even within the last week, we've had obviously new information come out with the ceasefire that's been signed, the 60-day kind of period, which we'll talk a little bit about today. Obviously, SpaceX and a number of other IPOs that are coming down the pipe as well have been on top of mind for a lot of investors as well. So we will touch base on that too. Goal today is to chat for probably 20 to 30 minutes and then have a Q&A session at the end. I imagine we'll probably stretch that out a little bit as we get through it. So without further ado, what I'll do is I'll introduce today's guest speaker. We haven't had her for over a year, and it's quite, like I said, exciting to have her and her input of what's going on in both Canada and globally. Theresa Shutt, for those of you that don't know, is our Chief Investment Officer here at Harbourfront Wealth Management, and she's responsible for the overall investment platform here within our organization. She began her career a number of years ago working as an economist for the Conference Board of Canada, brings a significant amount of experience in both private and public markets, and has demonstrated success in leading asset management teams over the years. Before joining Harbourfront, Theresa was the head of corporate debt for Fiera Capital, once again, responsible for overall strategic direction. So without further ado, Theresa, welcome. We appreciate you joining us today.
Thanks, Wes. Pleasure to be here. Good afternoon, everybody. So I think what we'll do is just get started. There's quite a bit to cover, as Wes mentioned. We're going to chat a little bit over the next 20 to 30 minutes. We're going to cover some pretty, big themes that are moving financial markets right now, and more importantly, what each of them means for you as an investor. I'm going to try to keep this, completely jargon-free. No acronyms, technical formulas, etc. Really just plain language about what's happening in markets, why it matters, and how smart investors are now reacting to it. So in terms of the main themes that we want to discuss, the first one is obviously artificial intelligence, not the science fiction version. This is the version that is right now generating real revenues and reshaping stock markets, as we see constantly in the headlines. We'll then talk about the biggest IPOs that are happening now in recorded history. That's the summer, and then we'll cover interest rates. We'll look specifically at Canada, the dollar, the economy, and obviously CUSMA, which is the trade deal that could move markets overnight. And then we'll finish with a conversation about private markets and why adding these unique and very exclusive assets to a portfolio has historically been one of the most prudent things that an investor can do. So let's dive in. We'll start with AI, because frankly, it's impossible to talk about financial markets in 2026 without starting here. A good place to start is these two numbers, the three numbers that you see at the top of the slide. So, obviously pretty striking. The first one, $500 billion. That is how much money the largest technology companies in the world, that means Google, Microsoft, Amazon, Meta, or Facebook, are spending every single year on AI infrastructure. To put that in context, that is more than the entire GDP of Sweden. And this is being spent annually on AI, and it continues to grow every year. The next number I think that is, striking is that 40%. And that really reflects the entire value of the S&P 500, which is, the main US equity stock index, which really represents a basket of 500 biggest US company. And that 40% is now the value of that comes from just 10 AI-related stocks. So 10 companies out of 500. That's 40% of the total index. And so, that concentration is at a level that we haven't seen since the dot-com bubble back in 2000, so roughly 26 years ago. And to best understand really the outlook for AI in these tech companies, the third number is also key. According to a study by MIT, which we know is a large university in the US that, obviously graduates many of these AI tycoons, 95% of AI projects deployed at companies have yet to turn a profit. So we have, an extraordinary amount of money being spent. We have extraordinary expectations being built. And the actual return of investment is still being figured out. And so, while all this has been happening, frankly, I think I'm quite comfortable in saying this is not a bubble. AI is not going away, but we're certainly at the show me the money phase. We want to see, whether this stuff is really paid off. So let's talk about, what's working, and that is real. So, as an example, there are things that are obviously, monetizing and delivering results. For example, Microsoft's AI business is growing at 123% per year. Amazon's cloud division, this powers most of the AI applications. It's growing at its fastest pace in 15 quarters. And then finally, these AI agents that we hear a lot about. And an agent really is effectively a software that can do work autonomously, like answering customer service calls or writing computer code. They're now deployed at more than 80% of Fortune 500 companies, and certainly we're trying to adopt them here. But the right column, I think, which is the kind of what to watch, and I think this is the interesting part. So when Broadcom, which is one of the biggest AI chip companies in the world, reporting its earnings a couple weeks ago, the stock fell 14% in a single day. So that's quite a move, and this wasn't because the results were bad. In fact, they were objectively excellent, but because the market had expected them to be even better. And so what is really happening is in the market, particularly for these AI names, they're really pricing for perfection. And it's really the single biggest risk in AI investing right now. So even though the companies continue to grow, they continue to post profitable quarters, markets are expecting more. And if you don't deliver, then you're getting punished. So, at the end of the day, AI is not hype. The revenue is real. It's growing quickly, but not every AI stock is the best or is the same bet. And so I think that's really important. And we'll make that point again through kind of rest of the, the presentation. So I think this slide provides a helpful framework for thinking about AI as an investor. It's an asset class or a sector that's really nascent. It's new. It's not like oil or industrials or manufacturing, retail. I mean, everybody kind of knows what that is and how it works. And there's decades of experience watching these industry sectors through cycles, and there's tons of research being done. AI is evolving right before our eyes. And so I think what this provides is a good framework for thinking about AI, where there's 3 different layers to the AI trade, and they're completely different stages. So think of it, here's an analogy of building a city. So you have a city, you have buildings, and you have businesses within the buildings. So layer 1, I think, is the roads and utilities, which we call the infrastructure. And the infrastructure in AI are the chip companies like NVIDIA, Broadcom, the data centers that are being built across North America, and now they're talking about building some in space. We'll see whether that happens. And obviously the power infrastructure to run them, and that's including utilities, the construction industry like Caterpillar, and of course energy companies, and we're hearing a lot more about renewable energy and their role in building out this infrastructure. And this layer is generating real and large verifiable revenues. And so if you're a data center or you're a source of power, you're getting paid to provide that. And so that's obviously revenue generating, and that's real, or like, let's call it mature. And the risk here is that, when this layer, the business is not bad, but, has the stock price already, reached its peak? And does it already reflect all the good news and then some? So there's, always questions. Going back to then the second layer, this is the AI model. So imagine this is our buildings. These are the companies like OpenAI, Anthropic, Google's AI division, they're coming up with, the code, they're building ChatGPT and Claude and all these other, type of things that we're now starting to use day to day. And these companies, are still mostly private. Meaning you can't buy them on the stock market yet. And most of the value created in these companies have occurred while they've been privates. And we'll talk more about privates later on. But that's about to change dramatically, obviously, which is what our next slide will be about. Well, we'll talk a little bit about IPOs. But Anthropic, this is, again, this, the models and the data, that's being created, these algorithms, et cetera. This is a company that went from essentially zero revenue to $47 billion in annualized revenue in about 2 years. So, I mean, that's pretty spectacular. It's really the fastest corporate revenue ramp in recorded history. The last layer is, what we could maybe say is the buildings of the city. So the application layer. So this is the part of the AI value chain where AI is incorporated into the business models of every company, the healthcare, the legal profession, and even the investment industry. Some companies are really going to be transformed by AI for the better, while other companies may be significantly threatened or certainly challenged by AI. Software companies in particular that are constantly in the headlines, they've been challenged by this evolution of AI, as it may make some of their products and services unnecessary or redundant, or frankly obsolete. As an example, Salesforce, which is the biggest, customer relationship software company, it's a CRM company, it's down 33% this year. And that's despite it beating its earnings, continuing to perform, no decrease in subscription base. But it's declining because investors are asking, hey, if an AI agent can do the work of a salesperson automatically, why would a company pay for a Salesforce or CRM software at all? And that question really isn't answered yet. And so the stock price is continually, underweight, and is really priced for uncertainty. So the practical takeaway then from this is, when somebody says, I want to invest in AI, the question is really like what layer and what stage. The infrastructure layer, that's fairly mature. It's a bit more known, more stable. The model layer, which, Anthropic, OpenAI, we're now seeing come to public markets through these large IPOs. And then finally, the applications, which are a minefield. I think everybody's excited about it, but it may take longer than, many think to actually implement some of these applications in a meaningful way. And so what that means is really there's going to be, some winners and losers. And so I kind of like this picture, because it really shows that, in 2024 and 2025, we all had a pretty good run in the market. The exuberance behind any and all of these, layers of AI caused all tech companies to rise in value. And so the metaphor or analogy is similar to how like a rising tide at sea can raise all boats. But now there's more uncertainty on the horizon. We're talking about hype, and the waters have become more choppy, which could lead to significant disruption, could cause some companies to drown. And so I think there's still or there is more, I think, risk now involved, because now we're seeing these winners and losers emerge. You can't just pick NVIDIA or Google and put your portfolio and then just expect to outperform. So I think there's some important questions that are now starting to come. And so we can move to the next theme, which I think is really interesting. Something that I don't think many of us expected, probably, this time last year, maybe even 6 months ago, is this mega IPO wave of 2026. So if you look at the bar chart for a moment, the gray bar on the left, that is Saudi's Aramco IPO in 2019. So as you can see, it raised roughly, $30 billion. And Aramco is the world's largest integrated energy and chemicals company, and recognized, frankly, as the most profitable company in the entire world. And that was the biggest kind of or largest IPO to date. The navy bar next to it, now that's the value of the SpaceX IPO, which we saw on Friday. And this was $75 billion. Again, that set price of $135, raised, now the largest amount of capital in public markets. So nearly 3 times the previous world record. The company's share price, was set at 135, debuted at 150, and since then has surged over 50% from the offering price. So this is an event that's really quite monumental. It's made Musk the world's first trillionaire. And remember that the amount actually offered to the public represents only 4 to 5% of the total value of the company. And so it's hard to really understand or take that in, how much capital and value has been created in some of these businesses. And then finally, the two bars beside it, which is Anthropic and OpenAI, again, those are the model-based layer. These are each targeting $60 billion, with both expected to IPO in the fall. So together, these three companies, could add $4 trillion to the value of listed companies within months. For reference, the entire Canadian stock market is worth about $4 trillion. So the same amount that could be raised by these companies. And again, they're not listing the entire, all the shares of the company, just kind of that small percentage float. So this is important. It's fairly important for passive investing, index funds, because now NASDAQ has changed its rules to allow SpaceX to be added to the NASDAQ 100. And so what that means is a lot of these indices may be kind of forced to buy SpaceX automatically, whether they want to or not. So it's really created, what I would say is an artificial wave of demand that doesn't maybe reflect the true value of the business. And the call out box really says it simply, I think. History shows that the best entry points for these blockbuster IPOs come months after listing, not day one. And we'll come back to that, I think, on the next slide. So I think, IPOs, this is kind of a practical guide. And I think this is the slide that, you should definitely think about and kind of take home, is really the excitement about SpaceX. It's real, obviously fueled by the fact that Elon Musk has indeed built some fairly extraordinary things, but excitement really isn't an investment strategy. So if you look at the left panel, which is, kind of the historical warning, the red flag, on average, a stock bought at its IPO price underperforms the broader market by 20 percentage points over the following 3 years. Stocks priced at more than 40 times their revenue, so where their share prices, exceeds kind of that threshold, they tend to underperform by 58%. SpaceX is priced at over 90 times its revenue. And even in its own prospectus, the SpaceX prospectus, and that's a legal document that they file with the regulator, it says, and I quote directly, the company, quote, has a history of net losses and may not be able to achieve profitability in the future, quote. And this is the company saying this, not a critic. So it's important to kind of, again, excitement and what's really true value. There seems to be a bit of a disconnect here, but certainly it is breaking records. The middle panel, this is kind of the structural reality, and this explains why, kind of on day one, it is misleading. Again, I mentioned only 4% of SpaceX shares are available. The other 96% have been locked up. Elon Musk can't sell his shares in front of a year. So again, you have very small supply, high demand, which has artificially inflated the opening price. So the smart approach really, which I think is the kind of the message again to take home, that these companies will still exist, and be available for purchase, September or next year. And if you really generally want long-term exposure to SpaceX, patient investors can wait for some of these lockup expirations, and then they'll certainly get a better price. And here's the most important slide: like, you already own the AI theme through your existing investments currently. You have an equity allocation to your portfolio. You already own NVIDIA, Microsoft, Alphabet, and Broadcom. You don't need to rush into this IPO to be part of the story, and doing it through a prudently constructed portfolio that's diversified. You can protect yourself from that volatility, those market swings, and really kind of that uncertainty of how this all really plays out. So moving again, like maybe from equity markets, which tend to dominate headlines, to fixed income and inflation. So if many of you are watching, you knew that the Fed just had its meeting today with its new chair, Kevin Warsh, who's traditionally been a bit hawkish, meaning he likes to be very proactive in controlling inflation and high rates. But he's been obviously hired under Trump, who wants interest rates to decline. So like clearly he's at a bit of a crossroads here, and he decided today to leave rates leave rates where they were, not cut, not hike. His statement did come off a little bit hawkish. So the market is kind of seeing that as a sign perhaps that he may actually hike rates in the future if inflation can't be contained. But again, we don't really know. And so, we've talked a lot about rates. I get it. For the past 3 years, it's been everything we've talked about, particularly post-COVID, when interest rates went up as high as they did. But the picture has changed. So, the U.S. Fed Reserve's interest rate is sitting at like 4%. Now it's kind of at 3.75. And in terms of the overnight rate, and the Bank of Canada is sitting at 2.25. And I don't think the bank's going to move that much at all. And so the gap between these two overnight rates is actually quite significant, over 200 percentage points. And that's important for Canadians. Why? It's really because money will always flow to where it gets the best return. So that means that a lot of money is flowing into U.S. fixed income investments because that return is higher. And to buy U.S. fixed income investments, you need U.S. dollars. And so there's been, high demand for U.S. dollars, which means that, the Canadian dollar has been weakening as investors keep moving more money to the U.S. to get these higher rates. Now, the Bank of Canada, it's not going to hike rates because it wants to narrow that gap and get more money back because that could be, fairly negative for the economy. So it's kind of in this, kind of this two-headed dilemma. It's too weak to raise rates, as I mentioned, with GDP actually contracting in the last 2 quarters, but inflation is starting to tick back up because of the conflict in the Middle East. And that's, somewhat, closer to a resolution, but, we're still not quite across the finish line there. And what that has been doing is driving energy prices higher, which pushes up the cost of everything else that needs to be shipped, heated, or driven. So inflation has not gone away. And so these central banks in Canada and the US are kind of, they're somewhat paralyzed. And so, I don't think we'll get clarity on that probably until the fall. So really the Canadian bank can't really help the economy. It can't hike to fight inflation, and it can't lower rates, obviously, because, it would be something that I think, could introduce, stagflation depending on where the economy goes. So keeping on the theme then of Canada, I think the next one is, to talk about is CUSMA. So, overall, again, the Canadian economic picture is mixed. We're seeing real headwinds, but there are some bright spots. The headwinds, as I mentioned, where, Canada's economy actually shrank in the last quarter of 2025 and the first quarter of 2026. That's referred to as a technical recession. Unemployment is sitting around 6.5%, 7%. They're not really recession level numbers, but it is certainly softer. The housing market is still working through some of the rate cuts from 2024 and 2025. Prices haven't crashed, but they haven't recovered either. And, depending where you live, you're probably seeing that obviously firsthand. Again, as I mentioned, the Canadian dollar continues to be weak. But that said, if you have US dollar investments, because the US dollar has appreciated in Canadian terms, those investments will outperform. So other, kind of positive notes, the Canadian banks had a genuinely excellent earnings season. Scotiabank's earnings were up more than 30% year over year. They've raised their dividend. National Bank earnings were up 38%. And this is really because of wealth management. So, when stock markets go up, the fees that banks earn go up as well. So, that's obviously been a bright spot in the economy. And obviously since the Iran war, we've seen also energy companies do well. And previously before that, materials. So there's been a lot of really strong positive, these market tailwinds in Canada, but that is starting to cool somewhat. So the wild card really is CUSMA. And CUSMA is the Canada-US-Mexico trade agreement, which most Canadians we call it CUSMA or the USMCA. The joint review process kicks off in July. There's been a lot of posturing and positioning ahead of this, obviously, which started with Trump's return to office and all these tariffs that have been implemented that kind of, no longer take center stage, but I think we'll be back really kind of, in focus. And the U.S. has already proposed new tariffs of 12.5% on imports from Canada and 60 other countries. So he's kind of back at it to try to increase, obviously, U.S. revenues through tariffs. So, one aggressive statement from Washington, could move the dollar again, 2 or 3 cents overnight. And so, we are expecting some more volatility, even with the hopeful end to the U.S. war, U.S.-Iran war. And so, we'll see what the U.S. dollar does and how successful Carney is in reinstating Kuzma without having to give up too much. And so talking a little bit about, the Kuzma negotiations, this will really be pivotal for Canada's prospects next year and beyond. So, worst case scenario, there's no deal. We can see the U.S. effective tariff rate on Canada ratchet up by that, 12%, even higher, 15%. And this could permanently reduce the size of the Canadian economy. So the ability of the Carney government to secure a deal is imperative. But negotiating with Trump brings a lot of challenges, as we've seen. He's got a lot of tactics that are frankly actually outlined in his books on business probably 15 years ago. So none of this should surprise us. So his first tactic is he begins the negotiation by anchoring with extreme offers, and this is a tactic to really shift the conversation towards his terms and force the other party to kind of react to his starting point. Recall his assertion that Canada should become the 51st state. And when he started calling Trudeau governor. So, this is, one of his tactics that he'll use. Second, he always consistently frames outcomes as wins or losses. And there's little room for nuance. So by doing this, he's able to kind of align or motivate his team to move behind one goal and even by oversimplifying the complexities of the deal. And we've seen this certainly when he's done this in the Iran conflict. I think CNN put the number of times he said they were close to a deal or about to approach a deal, or that, Iran needed a deal really badly or wanted it really badly 44 times. And so this is a pretty standard tactic. Third, he'll create a artificial sense of urgency, trying to compel the other side to act quickly. We're starting to see that. And we'll see his unpredictability. That's another tactic. It really makes the other party kind of on their heels, and it's because it's really difficult to anticipate his next move, and it really undermines Carney's preparation. And finally, his use of public platforms. He uses that quite broadly to tilt the scales in his favor. He demonstrates how this can be used as a negotiation tool. He airs grievances, makes bold declarations, and creates additional pressure on the other party. So this is, I think, something we should expect over the next couple months. Carney seems to be able to have had some success in his tactics of being patient and not being easily bullied, but we'll see how this turns out. So that said, though, I mean, this is not all negative. Canada has a number of bargaining chips in the negotiation process, as we can see in this slide. So that includes like a stable and secure supply of energy, oil, natural gas. This has become particularly important of late. Canada remains a top producer of critical minerals, which are used in the AI value chain and in other types of infrastructure, computers and whatnot. And then potash, of course, which is the number needed by fertilizer that's needed by for farmers worldwide. And then finally, the timing of the midterm election in the U.S. This will put pressure on Trump to make a deal, particularly in light of his ever declining approval rating. So there's a few things that we have that are in our favor. So there's quite a lot of things to digest. With all of these events happening around us, what does it mean for your investment portfolio? Well, for one, it means that there's a lot of noise, there's a lot of rumors, but not much of it is frankly based on fact, even if the market seems to think it is. The uncertainty in the market really means that investors have to remain diversified across asset classes and geographies. I know that equity markets seem to consistently take center stage in the media, but frankly, that's only one component of an investment market or the investment world, as it were. And remember that putting your eggs in one basket really introduces significant concentration risk and volatility. As I mentioned at the beginning of this webinar, 40% of the S&P 500 is concentrated in 10 names. On the bond side, fixed income side, there's a lot of volatility and knowns about where interest rates are going. Regionally, there's some areas that are doing quite well and some that are not doing quite well. Emerging markets is actually outperformed the U.S. market over the past 18 months. So there's some interesting kind of factors. So as this slide says, different assets, zinc, one other ZAG, you need to diversify, mitigate that volatility, and reduce those losses. And this is what we always call as diversification being the free lunch. So by having exposure to a wide range of asset classes and geographies, this really helps you, reduce that volatility, reduce that correlation, and be able to have a broader access to different sources of alpha or return. And so this is really what we talk about at Harbourfront a lot, and is really kind of, I'd say, the foundation of investing in these types of markets. So this brings me really to the last slide, which is the case for private assets. This slide makes the case, I think, more powerfully than any words that I could say. So let me walk you through the first chart. So, look at this one on the left-hand side. This is the what they call the drawdown, or the maximum, reduction or negative return that occurred during this period right after COVID, or during that COVID period. So in about 5 weeks, the S&P 500 fell nearly 20%. So if you had $1 million in equities, you lost roughly $200,000 on paper in 5 weeks. So that's huge. A traditional 60-40 portfolio, you lost roughly 14%. So that's still very significant, better, but still pretty brutal. And now look at the teal bar or the green bar. This is a diversified portfolio that includes privates. This fell only 9.5%. So that's less than half the drawdown of the pure equity investor. On $1 million portfolio, that's a difference of $100,000 that you didn't lose. So that's a lot of money. And why does this happen? It's because private markets, things like private equity, private debt, infrastructure, they don't trade on public exchanges, every second of every day, like we see with bonds and equities. Their values update quarterly. They're not subject to, panic selling or emotional swings or noise or, tweets. They're really priced based on the fundamental value of those investments. And so in a crash or even just a market pullback, that stability is enormously valuable. We had the same experience in 2022 when interest rates hit record highs post-COVID, which also resulted in a significant market correction. And you can see there, the drawdown for the diversified portfolio with private markets, was less than 5%. And so this is really, we could dive into, private markets, but that's probably a webinar on its own. But I think this is really kind of the most, compelling case, and why it needs to be included in your portfolio, and why we see obviously all of the large institutional investors like pension plans, CPP, holding anywhere from kind of 50 to 60% of their total portfolios in private markets. So just to kind of maybe wrap things up a bit, I think, it's good to kind of distill everything to a few points that, you can remember that are easy to remember. The first is that, really AI, it's real. The revenue is real. It's reshaping the economy. This is not a bubble that's going to burst. But not every AI stock is the same investment. It's important to work with an expert like Wes to help you navigate this very new and complicated space. It's not going away, but there will be some winners and losers. Number two, this kind of trend of mega IPOs, they are generally historic events, but history also says that patient investors get better entry points than day one buyers. So you don't need to rush. The best companies will still be there in September. And granted that, your portfolio managers or fund managers that you're invested in, have access to, to these names, and they're already participating, but probably in a much more prudent way than the average retail investor just, buying the stock on day one. The third point is look, rates will be higher than we expected. We thought, rates would really start coming down probably beginning of this year. Central banks are continuing to struggle with these conflicting signals, and that could create some more volatility in bond markets. But, again, just be careful of too much equity. For obviously the CUSMA review, this is specific to Canada. But I would say it's our single biggest risk event of 2026. One headline can move the loonie by 1 or 2, 3 cents a day. So make sure your portfolio isn't overexposed to this buyer income, and obviously work with managers and the experts who kind of know how to navigate how this is going to evolve. And then finally, private markets still deliver lower drawdowns, higher long-term returns, and access to companies that aren't available in any public index. The opportunity set for privates is 10 times that for public markets. Again, you have to do a lot of due diligence. You have to work with experts who understand this space very well. And the price of admission is some patience, but it's been historically, paid off and providing benefits. And then finally, I think a final thought is that, the investors that have succeeded over time, they're not the ones who predicted every market move or tried to time the market. Nobody can do that consistently. Successful investors are the ones who stay disciplined, stay diversified, and stay patient through the noise. So that's all I have for today. And I hope that some of these kind of insights that we've shared are useful. I think there's a lot of things going on. I felt that these were the 5 big kind of trends or developments that we were reading a lot about. And hopefully you were able to gain some useful knowledge. And of course, I'm happy to answer any questions. And Wes is here as well to answer questions as well.
Thank you, Theresa. All fantastic comments and similar to what we've been kind of communicating over the last 6 months. Lots of headwinds, obviously, both from a geopolitical point of view, interest rate environment, economic, and so on. So I think taking that disciplined approach for those that have done it, those types of investors have been rewarded, because we've seen shifts in messaging pretty quickly, and what seems like it's going to be a period of prolonged contraction actually reverses course within a matter of weeks versus months. So just a couple of comments before I jump into a couple of questions that I have. If you do have questions, now's the time to add them. I do have a few here that I'm gonna get Theresa's opinion on, but again, the points that she covered they are top of mind. These are the types of questions that we're actually getting from a lot of the individuals that are on this call. One of the things I thought I would ask you, Theresa, is generally speaking, we do talk about diversification, but we also, being Canadian, have an opinion on U.S. stocks more, beyond just the fundamentals.
Yeah.
And so we have had, in the last 12 to 18 months, trade and tariff policies last year, and then obviously the geopolitical situation this year. We've actually had inquiries that have said, hey, should I remove U.S. equities altogether from my portfolio? And I have an opinion, but I would be interested to hear what you and your team, how you're viewing U.S. equities and U.S. investments just in general.
Yeah, no, it's an excellent question, because, as we've seen, the TSX and the TSX S&P outperformed, the U.S. market. And we've seen that, even in Europe and Asian markets, the COMC in South Korea, they're continuing to post these really, very attractive gains. But, my view is you don't bet against the U.S. It is the world's largest economy. All of the innovation is coming from that country. The economy there continues to be resilient. You do have a bit of what they call a K-shaped economy, where a lot of wealth has been created from these stock gains for upper income individuals and whatnot, and then the other part of the economy, which is suffering because of stagnant wage growth and higher inflation or food prices. But the labor market's doing well. It has low tax rates. A lot of growth prospects. And the current administration is very business friendly, and I think that's all positive. So I would say, absolutely, we're keeping our U.S. exposure, but where we are, thinking about doing is, again, diversifying in those privates or other areas, that still provide exposure to the U.S. economy, but maybe less exposure to the S&P 500, which is again 40% concentrated in those 10 names. We looked at areas and fund managers that have more of a kind of mid-cap small cap, large cap approach, where they have bigger weightings in companies like industrials and, more defensive kind of plays, because we think, if there is a correction or something kind of goes wrong with the AI trade, you have some protection there. So I think the US market is going to continue to grow. I do think the Canadian market is going to soften somewhat. The TSX had some great gains from gold. We saw, the materials sector just kind of like hit it out of the park. But I think that was temporary and that was structural. And a lot of that came just from central bank buying. I don't think those tailwinds exist anymore. We've seen a really attractive run up because for energy companies. But now we've seen, the price of oil start to cool. And I think the US is just full steam ahead. So, my view is, again, don't bet against the US.
Yeah. And I think you see some of that now with, you talked about the winners last year, digital currency,
Yeah,
hard assets like gold or silver. They're some of the worst performers this year.
that's true. Yeah.
Right. And I think that's important as an investor, is that we don't chase kind of what's hot today.
Correct.
Because often you're left holding the bag on the following year. So,
Yeah.
So the second comment here is we're seeing kind of two different types of markets, or at least this is the way I'm interpreting it. We have this event-driven or media-driven market where we get a lot of noise and we see very quick swings in the markets. And then in this last quarter of earnings season, we actually saw really strong earnings out of the US, and it was one of the strongest ones that we've seen on record. So as you mentioned, I think you said about 44 times, Trump has come out and talked about this ceasefire, what have you. And what's your take on the market just kind of getting exhausted from this noise and reverting back to some of these fundamentals? And where do you see that maybe going for the balance of the year?
Yeah, it was quite interesting, I think, for anyone in the market, watching, AI still take center stage when, the negative press from the Iran war and the impacts on inflation, the price of it, like the price of oil, the fact that Europe gives 20% of its natural gas, which it uses as its primary power source, wasn't able to get that. You see China, you see they're using gone through all their reserves. So it's kind of like that leaky bucket that you're filling up, but it's got a hole in it. And so it was surprising to me that didn't take some, heat off the AI trade. And there was, that tendency to kind of look through, for the positives. But that said, I mean, the expectations for AI names has gone up as well. So you saw that with Broadcom and some of these others, or Salesforce. And so you're seeing, kind of a realignment there in the AI trade. So I think people are of the view that, the ceasefire would end. And I think, with Trump coming up to, the midterm elections, he has to get that sorted because, the inflationary impact of higher energy or oil prices, for the average consumer, which, and frankly, his constituent base would not be tenable. And so I think people kind of bet on that to force a resolution or for Trump to send Trump back to the bargaining table, to come up with a deal. Now, will this deal be better for the US? I don't think so. I think it'll actually be worse. I think he'll end up giving up stuff just to get a deal done. But knowing Trump, he will position it as a win. This is what he's done in the past, and he'll continue to do that. But it was surprising to me, which made me kind of think twice about, betting against the US and betting against AI. And I know I use, from somebody who didn't use AI at all 3 months ago, I now use it 5, 6, 8 times a day.
I mean, it's just the way it's going to change the way we live our lives. There's no question. Sure. And again, and this is why, as we go through this innovative wave in just, the economy, you have to be participating somehow. You're going to miss out altogether.
Yeah, for sure.
So I have one follow. I actually have a good question here, and I'll kind of put this together. You provided a real mix of economic kind of data. Obviously the banks and some sector-specific companies are doing really well. The economy is mixed. The dollar and CUSMA, obviously, there's some risk there. So the two questions I have is the comments on the Canadian banks trading at historic multiples.
Yep.
What do you see as the downside risk and the strategy of owning them? So that's question one. And then the second one I have, and it kind of maybe goes together with this, is what's on the radar for your team? So as you're looking at the AI trade, we have this question about Canadian banks. As we look through the balance of the year, what's your takeaway based on all the data that we're seeing mid-year?
Yeah. So I think, generally speaking, I think, we've talked about obviously the US and again, I think they've got, strong prospects there. I think that economy is going to continue to do well, and the AI trade is going to help that. For the financial sector, I mean, Canada's very interesting, right? It's frankly out an oligopoly. There is no true competition. And banks are able to play in so many different spaces, right? So if they don't, do well in one area, maybe retail, they do well in another area. And so I think they've got, incredible moats around their business. And they're highly protected, which is why they continue to be profitable. So one thing I mentioned is because of the stock market gains, we've seen wealth management, the fees that are earned by the banks do really well. And that's been part of the game. But also we're seeing a lot of deal activity come back. So a lot of M&A, a lot of those transactions, so investment banking fees have done well. And I think, that's helped fuel the bank. So I don't think they're overvalued. I think, they're actually a pretty nice defensive play in the Canadian market. So when we've actually looked at the Canadian space, we did have some positions tactically in kind of a value, Canadian value, which was both energy and financials. We transitioned away from that into actually financials because we just think that's a more attractive place to be. And I think, for us, again, having more, like as many eggs in our basket as we can. So we really like some of the international managers that we've added. They've done really well. And we've had some, value investors that have, generated 30% returns without AI. So I think, I think this is it's a good market for active management. I don't think I would want to be investing passively or in ETFs right now, because I think there's more risk there, particularly with what's happening with SpaceX. I think that will create a lot of noise for these indices, and the concentration, it's just not going away.
Yeah. And just one comment about the trade or your outlook on banks. I think of it also from a cash flow point of view. Go back 3 years ago, 2022, 23, when rates were higher, you could park money and make 4 or 5%, which was a decent return. It was typically above inflation, but it was fully taxable. And so today, with a basket of good quality dividend producing companies, whether it's banks or utilities or what have you, you can generate a better distribution than a GIC. And it's tax preferred. So you're left with more dollars in your pocket as well. So I think that trade, that Canadian trade, there's a lot of, it's very attractive in general. And that's what we've seen as a complement to our US allocation. That Canadian allocation, which we've increased over the last couple of years, has actually done really well for the family. So,
and I think too, the banks are going to be, in my view, the first to benefit from AI. I think they're going to implement AI on very large scales. I think it'll allow them to reduce their workforce anywhere from 10 to 15%. I think this is already happening. So they have huge back offices, operations, call centers. I think that's all going to get automated. I think that's the unfortunate side of AI. But I think that's happening with some of these banks. Obviously, you'll see this too in accounting firms and law firms, because I think AI will do this. Anything that's rules based, but accounting firms and law firms are the private partnerships. You can't participate in that as an investor. But I think the banks, they're going to be the most successful, I think, in the short term at implementing AI for cost savings, and we're going to see that in their profitability.
And I think that's actually a really good point, right? You're seeing a lot of this CapEx, a lot of this spend with these AI-driven companies. You talked about the top 10 in the US. But really what's happening, and we're seeing it now, is that ripple effect. A lot of those investments are now going into other sectors like the financial sector. And there's a direct cost savings, which means there's more profitability, dividends get increased, shares go up and so on. So
I think they're not talking about it much, because I think they're using AI for the negative part of it, which is job losses and things like that. I mean, they'll call it efficiency. So I think this is why the banks are being very clever or cagey about it, I think, about, talking about how much they're going to start using it.
Yeah.
Understandably, it's not, it's probably optically not a great look for them, but they're all doing it.
Yeah. At the end of the day, they make decisions based on their share price more than,
Yeah.
and that's why we're seeing this migration of Canadians that are moving away from banks, right?
Yeah.
So
For sure.
Well, listen, Theresa, I can't express how fortunate we have been to have you join us for the last 45 minutes and answer these questions. For those of you that are on the call, if you do have questions that you didn't get a chance to ask, if you can send us an email, send me an email. I'm happy to pass it along to Theresa to get her comments as well. Again, we really appreciate you joining us today on this Wednesday afternoon. And go Canada. Like I said, obviously enjoy the game tomorrow for those of you that are in town here in Vancouver. For those of you that are across the country, I'm sure we'll all be sitting in front of our TVs. So once again, thank you for joining us. Thank you, Theresa. Much appreciated. We wish everybody a good day and good rest of the week.
Great. Thanks, everybody.
Guys,
Take the opportunity. Take care.